One question we get asked a lot is, how do I make sure I don't end up paying more than I have to in taxes as part of my estate plan? And that's a great question, and it depends on your specific circumstances. But I wanted to give you a quick overview of the three types of taxes that we're concerned about when we put together a relational estate plan. They are income taxes, capital gains taxes, and estate taxes. Let's start with income taxes. Now, you're probably already familiar with income taxes. Their tax is on what you earn. So when you earn money each year, you have to pay taxes on it as part of the tax return that you file with the IRS. Now, they come into play with estate planning because of individual retirement accounts, IRAs. Sometimes these funds are also held in similar accounts called 401ks, 403bs, or TSB accounts. Essentially, these are accounts where the money is taken out before you pay income taxes on it. And so when you die and pass these on, the IRS makes whoever you leave them to pay income taxes. Now, when they pay the taxes and how soon they have to pay the taxes depends on their age and their relationship to you. But it's really important that you have a good strategy for making sure that you don't end up paying more than you have to, or your family or loved ones don't end up paying more than they have to on these taxes. Capital gains taxes are taxes on the increase in value of an investment. So if you buy stock for $100 and it goes up in value to $200 and then you sell it, you have to pay taxes on that $100 gain. Now, these come into play with estate planning because of something called the step-up in basis rule. The step-up in basis rule says that when you die, if you pass on assets in a certain way that have increased in value since you purchased them, the people who receive those assets don't have to pay capital gains tax on the increase in value before you died. So when you set up an estate plan, you want to make sure that you take advantage of this step-up in basis rule. The third type of taxes that comes into play with estate planning is the estate tax. Now, this is sometimes called an inheritance tax or a death tax, and each state has its own system of death taxes or inheritance taxes or estate taxes. But I'm going to limit my comments to the federal system because that applies to everyone. Under the federal tax system, the estate tax is around 40%. But there's an exemption, and right now it's about $12 million a person. So what that means is that you can give away up to $12 million during your life or at death, and without incurring any estate tax. And there's some other rules that apply here as well, ways you can give funds away to charity or certain amounts every year. But essentially, with this exemption, the estate tax doesn't apply to most people. Now, if it does apply to you, then having a plan that addresses it is very important. And even if you don't fall into that category of folks who have an amount right now that's subject to the estate tax, that $12 million exemption is scheduled to come down. And so if you're close to it, you still want to make sure that your estate plan addresses this so you don't end up paying more in estate taxes than you have to. Now, just to be clear, your exact plan will depend on your assets, your tolerance for risk, how much you're leaving to different individuals, and their financial situation. So those are the three types of taxes that apply to estate plans. If you have questions about how any or all of these taxes apply in your specific situation, please give us a call. We'd be happy to discuss it with you.